Dear students, I am Dr. Panduranga Nayak, Principal SVS College, Bantwal. Today I am going to make a presentation on final accounts of non-trading concerns, video number 5. And in today's class, I am going to tell you about capital expenditure and revenue expenditure. Then deferred revenue expenditure. So these three concepts I am going to explain in this video. First we'll take up capital expenditure. Capital expenditure is an expenditure whose benefit is not exhausted in just 1 year but is available for more than 1 year. It's very clear. Expenditure whose benefit is not exhausted in just 1 year. That means it's available for more than 1 year. For example, land, building, machinery, plant. So they're going to be used for a long period of time. Anyway, it is more than 1 year. Therefore, such expenditure is called capital expenditure. It is expenditure which is incurred on the acquisition of any fixed assets. I already told you, land, building, machinery, furniture, even intangible assets like goodwill, copyright, all this come under capital expenditure. Fixed asset, acquisition of any fixed asset, or which adds to the revenue earning capacity of the business. So that will enhance the earning capacity of the business. So you are having one plant now. You may add one more plant so that you will enhance or increase the revenue earning capacity of the business. Capital expenditure is incurred either for acquiring fixed assets like land, building, machinery, furniture, etc. for use in business for the purpose of earning income. That is not; these are not meant for resale, rather they are for use or for increasing the revenue earning capacity of the business. So, fixed assets are capital expenditure whose benefit is not exhausted within a year. That is going to be used in the business for a longer period of time. And that will result in acquisition of certain assets. I told you fixed assets, land, building, machinery, furniture, copyright, trademarks, goodwill, etc. So that will help you to enhance the earning capacity, or that is for the purpose of earning income. Okay, now let us see some of the features of capital expenditure. First one, capital expenditure is non-recurring in nature. It does not recur. You don't purchase machinery every day. You don't purchase land every day unless you are a dealer in that. If you are a dealer in that, then it will not be your fixed asset. Then it is considered to be an item of goods. Okay. The benefit of capital expenditure extends to 2 or more years. So the benefit will not be exhausted within a year. If it is exhausted within a year, it is a revenue expenditure, not capital expenditure. So the benefit of capital expenditure is extends to 2 or more years. Generally, it involves huge amount. It will appear in the balance sheet. These are some of the features of capital expenditure. Now let us take some of the examples. Cost of fixed assets such as land, buildings, machinery, patents, vehicles, furniture, tools, etc. purchased for use in the business, not for resale. If they are meant for resale, then that will be goods. Whereas if it is for use in the business, then it will be fixed assets. And cost of fixed assets is example for capital expenditure. Cost of addition or extension to existing fixed assets. Now you are having a building, let us say, you may add one more floor, or you may extend it by adding a few more rooms. So that way, cost of additions or extensions to existing fixed assets. Now if you have got one machine, you may buy one more machine. If you have got 10 machines, you may add 2 more machines. So that way, any additions or extensions to existing fixed assets. Any expenditure incurred in connection with fixed assets such as legal charges, any expenditure and brokerage paid for acquiring the land and buildings. So any expenditure incurred in connection with purchase of any fixed assets like legal expenses and brokerage. Similarly, expenditure incurred in bringing the assets purchased into the business like carriage or freight paid for bringing the machinery purchased. Ordinary carriage, that is revenue expenditure on goods especially. Whereas here, carriage of freight paid for bringing the machinery into business, then it is capital expenditure, and carriage of freight is added to machinery account. It will not be debited to, in the case of trading account, trading and profit and loss account, in the case of income and expenditure account. Okay, it will not be debited to expenditure account. Expenditure side of income and expenditure account. Next, expenditure incurred for installing the fixed asset. So installation charges, cost of erecting, for example, machinery. So that is an example for capital expenditure. Wages paid for installation of a machinery. That is an example for capital expenditure. Actually, ordinary wages are revenue expenditure, whereas wages paid for installing a fixed asset is a capital expenditure. Any expenditure incurred on the alterations and improvements to existing fixed asset so as to increase the income earning capacity. For example, a useless machine might be thoroughly repaired or altered or improved so that it will enhance the earning capacity of that vehicle, then it is a capital expenditure. Then development expenditure like amount spent on tea or rubber estate before it is started yielding. So any development expenditure like amount spent on tea or rubber estate before it has started yielding. The next, cost of investments purchased and brokerage paid for purchasing the investments. For example, shares purchased and you might have paid brokerage on purchase of investments. So then the brokerage will be added to the investment and the total is considered to be capital expenditure. So these are some of the examples for capital expenditure, and these are shown on the asset side of the building. For example, fixed assets, you might have purchased fixed assets. Where do you show in the final accounts? So that will be shown on the asset side of the balance sheet like land, building, machinery, furniture, vehicles, tools, or say patents, goodwill, etc. Okay, now we'll move on to revenue expenditure. Having understood the capital expenditure, it is very easy to make out what revenue expenditure is. So revenue expenditure refers to expenditure whose benefit is exhausted within 1 year. So its life is short, and the benefit you can receive, receive only for, or that will be exhausted within a year. For example, salary is paid. So once you pay the salary, the benefit will not be received for many years. So you have to pay every month the salary. Salary you have to pay every month. Rent you have to pay every month. Commission you have to pay every month. Then office rent you have to pay every month. So thus, it's not enough if you pay salary for 1 month or rent for 1 month, commission once. So it recurs. So the benefit is exhausted within 1 year, and it is incurred for day-to-day running of the business or for maintaining the fixed assets of the business like repair, maintenance, etc., or for maintaining the fixed assets of the business in efficient working condition. So very clear, revenue expenditure is one, the benefit of which is exhausted within 1 year. Normally short period, that is one year. It is incurred for day-to-day running of the business, or for maintaining the fixed assets of the business, or for maintaining the fixed assets of the business in efficient working condition. Thus, revenue expenditure is expenditure which is recurring in nature. So it recurs, it happens very often. As I have told you, rent, for example, every month you have to pay, or at least once in 3 months you have to pay, or at least yearly you have to pay. So it's not enough if you pay the rent once and use it forever, not possible. So it is recurring in nature, the benefit of which is exhausted within 1 year. The amount involved is small and it will appear in the profit and loss account in the case of trading concern, or in the income and expenditure account in the case of non-trading concerns. Let us see the examples. Cost of goods purchased for resale. So if it is for resale, then it will be revenue expenditure. Expenses incurred in bringing the goods purchased to the place of business, such as carriage, freight, etc. If expenses are incurred for bringing the assets, then it will be capital expenditure. If it is on bringing the goods purchased into the place of business, then it is revenue expenditure. Example, carriage, a freight, etc. paid on goods purchased for bringing that into the business. Cost of materials consumed in the manufacture of goods meant for resale. Cost of goods consumed in the manufacture of goods. Okay, raw material or labor, etc. These will be taken as cost involved in the manufacture of goods. Expenses incurred in manufacturing the goods for resale, such as factory wages, power, factory rent, factory insurance, all these are taken as revenue expenditure. Expenses incurred in the day-to-day management of the business, like salaries, rent, printing and stationery, postage, etc. What do we call that? Office and administrative expenses. We also call that expenses incurred in the day-to-day management of the business. Then expenses incurred in selling the products, such as advertisement, commission paid, repair, replacement and renewal of fixed assets. So maintaining the fixed assets. Financial charges like interest on loan borrowed, interest on deposit accepted, interest on capital, etc. So that is financial in nature. So any expenditure incurred which is in the financial nature, like interest on loan borrowed, interest on deposit accepted, interest on capital, etc. As I have already mentioned, in revenue expenditure will be shown on the debit side of the income and expenditure account of a non-trading concern. If it is a capital expenditure, that will be shown on the asset side of the balance sheet. Revenue expenditure will be recorded in the income and expenditure account, whereas capital expenditure is shown on the asset side of the balance sheet. Next, deferred revenue expenditure. Defer means postponing. Postponing what? Postponing of writing off the cost of the asset. So what do you mean by deferred revenue expenditure then? It's a revenue expenditure. When you look at that, that appears to be revenue expenditure, but which is not completely written off in the year in which it is incurred. It's not completely written off in the year in which it is incurred, but it is spread over the years during which its benefit is available. So sometimes you may incur the deferred revenue expenditure, the benefit of which might be received over 5 years. Okay, it is called deferred revenue expenditure because its writing off is deferred or postponed. That's one thing. Its writing off is deferred because of two reasons. One, the amount involved is huge, and it's not fair to debit the entire amount to the income and expenditure account of 1 year. Similarly, the benefit of the expenditure extends to 2 or more years. So because of these two reasons, yes, writing off of the deferred revenue expenditure is either postponed or deferred. That's why it is called deferred revenue expenditure. Okay, normally revenue expenditure will be written off within a year because the benefit does not extend beyond 1 year. Whereas deferred revenue expenditure means when you look at that, that appears to be revenue expenditure, but its benefit will not be exhausted within a single year. So it extends for more than 1 year, maybe 2 years, 3 years, 4 years, etc. Now, what are the examples for deferred revenue expenditure? Number one, huge amount spent on advertising of a new product. When you launch a new product, you incur huge amount for popularizing the product. People must come to know about the availability of the product in the market. For that, you have to spend a lot on advertisement. We call that advertisement campaign. So, in that case, if the benefit is for 5 years, so the cost will be spread over 5 years. For example, say 50,000 is spent on advertisement and the benefit is extended over 5 years. Then, say in first year, on the asset side of the balance sheet, 50,000 of that 10,000 will be written off. So 50,000 minus 10,000, the balance is 40,000. The 10,000 will be debited to profit and loss account. So 10,000 is debited to profit and loss account. Second year, out of 40,000, again 10,000 is written off. And that 10,000 is debited to profit and loss account because it's a loss. So in the balance sheet, what remains is 30,000. That way, you're going to write off part of the asset every year so that at the time of life, entire amount is exhausted. So that is an example for deferred revenue expenditure. Exceptionally heavy amount spent on repairs to an old asset. See, if you spend on ordinary repairs, that is for maintenance of the asset and that is taken as revenue expenditure. So here repairs is carried out on old asset and exceptionally heavy amount is spent on that because you are converting that into usable asset and that will help you to enhance the earning capacity. Therefore, in that case, that will be capital expenditure. Here, anyway, it is capital expenditure only, so it is called deferred revenue expenditure. Expenditure, when you look at it, revenue, but it is capitalized and every year part of that you are writing off. Therefore, it is called deferred revenue expenditure. Preliminary expenses. Preliminary expenses means what? Expenses incurred at the time of formation of a concern or before the firm or a company or whatever it is comes into existence. So before the business concern is brought into existence, whatever amount you spend, that is called preliminary expenses. For example, in the trading concern, I will take an example of trading concerns, a company. So cost of drafting memorandum of association, articles of association, prospectus, forms, etc. Then printing of all these things, and then preparing prospectus, discount on issue of shares. Okay, I'm sorry. All these are examples for preliminary expenses. Expenses incurred before a firm or a company or a business come into effect. The brokerage paid or discount allowed by a company on the issue of shares and debentures. Here, my explanation is not confined to non-trading concern only. In general, I am explaining what is preliminary expense. So, brokerage paid or discount allowed by a company on the issue of shares and debentures. Undertaking commission paid by the company on the underwriting of shares and debentures. What is underwriting? For example, a company may go for public issue of shares, and there is a condition called minimum subscription. So if the company is not sure that the minimum subscriptions, public will subscribe for at least of the minimum subscription, then they consult or contact underwriters, enter into an agreement. Underwriters agree to purchase the shares only if those shares are not purchased by the public. If there is full subscription, underwriters need not buy those shares. On the other hand, if it is undersubscribed, then that portion of subscription which is not taken up by the public will be taken up by the underwriters. For that, they charge commission, that is called underwriting commission. Any loss of extraordinary nature. So all these are examples for deferred revenue expenditure. Now how it is treated in the balance sheet, as I have told you, every year part of that you are writing off, that will be debited to profit and loss account. The balance will be carried forward in the balance sheet asset side. I was telling you about, say, advertisement, heavy advertisement incurred for introducing a new product or launching a new product. Supposing you spend 50,000 on advertisement, then say life is for 5 years. You think that the benefit is extended over 5 years, then 1/5 of 50,000, that is 10,000, will be debited to profit and loss account. 50,000 minus 10,000, remaining 40,000 will be carried forward in the balance sheet. Next year again 10,000, 1/5 of original value, that will be debited to profit and loss account, income and expenditure account in the case of non-trading concern. And then remaining 30,000 will be shown on the asset side, outer column of the asset side. Fourth year again 10,000 debited, and in the balance sheet it is 20,000. So that way it goes on. Okay. So the amount of deferred revenue expenditure which is written off during the year is entered in the income and expenditure account, and the amount which is not written off is entered on the asset side of the balance sheet. Thus you have studied three things. One is capital expenditure, second one is revenue expenditure, third one is deferred revenue expenditure. In the following classes or subsequent classes, you are going to study more about this with the help of certain examples, with the help of certain problems, etc. So thank you very much for listening to me.